Hello, everybody. Welcome to Intermediate Accounting 17th edition video solution walkthrough for exercise 1417. This question comes from Intermediate Accounting, the 17th edition textbook, authors Don Kiso, Jerry Weingant, and Terry Warfield. The question used in this presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or Wiley. Okay, so hopefully I don't have to remake this video too, but you never know. Okay, so right over here, take one of exercise 1417. So write purchase land that had an assessed value at the time of purchase, a $500,000, $550,000 zero interest-bearing note due January 1st, 2023 was given in exchange. There was no established exchange price for the land. That's kind of important, nor readily fair value for the note. The interest rate charged on a note of this type is 12%. Determine at what amount the land should be recorded at January 1st, 2020, and the interest expense to be recorded in 2020 related to this transaction. So what I would say over here is that the way I would want to record this is going to be the lesser of the assessed value or the discounted amount of the zero interest bearing note. And if I look at this over here, so 1/1/20, 12/31/20, 12/31/21. And we're just going to kind of say, because like the following year, this is due on 1/1/23, so it's kind of the same thing. So we're going to have to pay at this point in time $550,000. So how do we go through and do this? Okay, so right over here, the note, or excuse me, we've got 550,000, which is the note. We've got the present value of an ordinary, present value of $1. This is going to be 3 periods at 12%. So I'm going to go over here to 3 periods at 12%, and I'm going to get 0.71178. And when I multiply this through, I'm going to end up getting 391,479. Now, my problem is, like, if this over here, so let's see what it really, let's kind of read through this again. I purchased land that had an assessed value of $350 at the time of purchase. I issued a $550,000 zero interest bearing note that was given in exchange. There was no established exchange price for the land nor ready fair value for the note. So we've got an issue here, okay? The interest rate on a note of charge of this type is 12%. What amount should the land be recorded out on January 1st, 2020, and the interest expense to be reported? Now, with this over here, what I really kind of, what kind of is bizarre is that if it has an assessed value at the time of purchase, right? What is that, like the county assessor? If I recorded at 391,479, right? So we can't use the 550 note because that's not what it's worth. So if I record it though at the 391,479, am I overstating the value of the land because the assessed value is lower? So let's just pause real quick and I'll see what their thoughts are. So let's take a look really quickly. What does assessed value mean? Well, the market value refers to the price of your home, and really the assessed value is the estimation your home value is accorded that's used to assess property taxes. Okay, so they're the property tax collector. So if I come over here and if I say that market value and assessed value, that it might not be the assessed value, maybe what this may be referring to is more of a historical value, right? Depending upon where this was taking place in the country. So The assessed value in this case right here of 350, that may not be an indication of market value. So as I look at this right over here, then the discounting the $550,000 note at 12% is probably going to be the way that we want to go with this. So we'll go ahead and leave it at the 391,479. Okay, so this is, I'm going to debit land for 391,479. I'm going to have a discount on notes payable of the difference between the actual amount of the note and over here, and this will be notes payable. Okay, so 1/1/20. Okay, so on 12/31/20, what is the interest expense going to look like? And I'm going to have to record interest expense. I'm going to credit the discount on the bonds payable, and this is going to be to record interest expense. So as I look at this here, my note payable is always going to be at 550. My discount, though, is going to depend upon where I am. So my discount on my notes payable was at 158,521. My note payable carrying value is going to be the difference between these two right over here. So the way that I'm going to record the interest expense, the way I'm going to record the interest expense is going to go ahead and take the interest rate at 12%. So my interest expense is going to be 46,977. As if you want to take a look at my walkthrough in terms of the, if you want to take a look at the walkthrough for 14/16, where I do a little bit more of an in-depth on this. But what I'm really trying to do ultimately is when I go to pay the note, I want the discount to go down to 0. So my first year amortization is going to be 46,977. So that's going to be the interest that I make. But let's just go for fun. Let's go make sure this actually works. So I take 158. I basically subtract this 46,977. So my discount at post amortization is 111,544. My interest rate is still not going to change. Once I set in that interest rate, I do not change it. So my amortization of my discount in 2021 is going to be 52,615. And then over here for my final, for the final show, this is going to be over here at 58,929. And as we can see, what ends up happening is that by the time we are ready to pay off this note at the end of the third year, this discount on notes payable has been fully amortized. So that's how we go through and record it. Remember, if I see something that's 0 interest bearing, that's a load of malarkey. There's no such thing as free interest. We have to impute interest. Okay, so right here, so Field borrowed $5 million from Sonny's major customer through a 0 interest bearing note due in 4 years. Because the note is 0 interest bearing, Field agreed to sell furniture to this customer at lower than market price. A 10% rate of interest rate is normally charged on this type of loan. Prepare the journal entry to record this transaction and determine the amount of interest expense to report for 2020. So I borrowed $5 million from Sonny's, and I'm also, because I'm selling furniture to the customer. So it's really, there's something going on here, right? So it's not like basically if I'm borrowing money that I don't have to pay interest back on it, I do have to recognize some sort of interest expense. So right over here, my amount borrowed is 5 million. Okay, and this is going to be over here. This is going to be present value of $1, 4 periods at 10%. Okay, and then what I'm going to do over here, 4 periods at 10%. This is 0.68301. Okay, so my present value of the borrowed is going to be 3,415,50. So what I'm going to go through and do is I'm going to record the transaction at 1/1/20. I'm getting cash at 5 million. And let's see over here. So I'm getting cash at 5 million. Let's think this through. I borrowed 5 million. Okay. Okay, so I'm getting 5 million. So that means my note payable is also going to be 5 million. Now, I also have to show the present value of the amount borrowed. Oh, this is interesting. Just give me a moment. I got to go look at the solutions. Okay, so I'm partially right on this, right? So this part is good to go. However, I have to record a discount on the note payable, right? So this is going to be the difference between the amount borrowed and the present value over here of 1,584,950. Now, what's interesting is that they're putting this into, and if you kind of think about it, it may make a little bit of sense, but they're calling this unearned sales revenue. Okay, so that's what they're putting this, because this is actually really what it is that I'm selling items below cost. So it's unearned sales revenue. So this is to record issuance of a note payable. Wow, I didn't even think about this. Okay, so like, why did they get this kind of a deal? It was because they're going to get lower, they're going to get sell furniture to the customer at lower than market price. So theoretically, as an auditor, what you would do is you'd say, okay, or the management of the company, what you're going to do is say, all right, so how much furniture are we going to be selling to them? And then you'd have to allocate the unearned amount out. But for our purposes right over here, when it comes to the discount on the notes payable, the way we're going to go through and recognize the interest is I'm going to pause myself right again. Okay, so 1/1/20, my carrying value or my note payable is at 5 million less my discount. So my note payable carrying value is going to be 3,415,50. My interest rate is at 10%. So, and this is actually going to be 12/31/20. So my interest expense is going to be 341,505. So when we go down here on 12/31/20, I'm going to be debiting interest expense for 341,505, and I'm going to credit the discount on the note payable. So this is to record interest expense. So again, what's happening here? So I'm getting cash, I'm getting a full 5 million, and I'm issuing a note that's 0 interest bearing. So the challenge with that is that that's not really reality, because I would never get I would never receive free money. So when you're looking at this, you have to go through and impute interest, But the credit part of this is going to unearned revenue, which theoretically I would be recording to my financial statements over a period of time as I make those sales. So again, you probably would want to say like, okay, what did you promise them? What was, what's going on here? Okay. So let's now take a look at our discount on notes payable. And I kind of always like just to do this just to make sure that we're all on the same page, just to make sure my numbers work out. So what happened? So after this year, I went through and I amortized my discount on notes payable by $341,505. So the following year, my new discount amount is $1,584,950 plus the amount of the interest expense I recognized in the previous year. So this now gives me $375,656. And if I do this for another 2 years, we'll see if this works out. So this is $375, $413, and then $454. So at the end of the 4 years, I've gone through and I have successfully have amortized this. So my numbers are roughly about the same. Okay. So there you go. So exciting, fun stuff. And even I get tricked by the best of them. This definitely tricked me. So again, this was an interesting one. I'm not going to redo this video because I think it's helpful for you to kind of see the thought process of how to go through and to solve these questions. But there you go. Anyways, thank you for joining me. And I look forward to seeing you on the next video. Oh, by the way, thank you, Wiley. Woo! Yeah, thank you, Wiley. Don't forget to like and subscribe if you need other solutions, which I'll kind of go on divergence or hopefully not a tenant, hopefully not a reverse world, but please feel free to ask in the comments. I'll see you on the next video. Have a great one.